a decline with about 1:2 at this point of time, and we'll watch out how the session pans out in the later half as well. But for now, let's get to our big market voice segment. We have Seshadri Sen, Head of Research and Strategist at Emkay Global, joining us to talk more about markets. Seshadri, good morning. So good to have you with us. I mean, we are at a time when we are seeing heavy news, shifting news, sometimes relief rally, sometimes weakness. At this time, how are you reading the situation, and how do you think investors should prepare themselves to face such fast-changing and volatile times?
Thanks for hosting me. You're right. The short term will continue to be very volatile, and trying to chase the news flow on this on the Iran war is very tough at this point in time, because this is a very serious geopolitical conflict, and the sands will shift very quickly at any given time. However, we do think that if you take a slightly longer term view, say 2 to 3 months, the probability of some sort of settlement or peace coming through is very high. Of course, the key trigger would be the Straits of Hormuz reopening. And so from that perspective, I think if you take a slightly longer term view, we would look through the near term volatility, and the markets look quite attractive from that perspective.
Got it. Seshadri, we've been seeing that crude has seen sharp swings. I mean, it'll be nearly a month since crude has been staying above that $100 per barrel. So for India, oil above $100 per barrel for another month, if indeed the war gets prolonged, what would it mean?
Yes, it is. The longer crude stays above $100 a barrel, it does create a problem. And the longer would the recovery time be? It is like, being in the kind of stress that it creates on the economy and on companies. For every week that crude stays above, the recovery time is a multiple of that, as it were. The pain will be on 3 or 4 fronts. One will, of course, be input cost pressures and energy pressures. Second, and more importantly, which is what marks this crisis out from previous energy crises, is that availability will be a challenge. It was very heartening to see the government step up and say that availability is secured and we should not worry. So I think that in the short term, that has addressed any panic on that front, and we think things should be fine. But if it lasts for more than a month or so and the supply tightness remains, we've seen other countries get into very serious trouble. And while India may be slightly better off, there will be some issue in terms of the overall functioning of the economy. So it's not just normally an energy crisis is a financial and a price problem. In this case, it's an availability problem. So you would see factories shutting down, you would see consumption, per force coming down, and that represents a different dimension to the problem.
Got it. Seshadri, in your strategy note, you have mentioned that if indeed crude stays above that $100 per barrel, it would mean that Nifty can crash up to 21,000. I mean, that implies about 8 to 9% correction from the current levels. So at this point of time, should investors wait before deploying money, or should they start accumulating positions?
Yes, that is the scenario if crude stays above $100, say, for 2 months. We could see, or even another month and a half. You could see a scenario where the index goes down significantly. The 21,000 comes from previous valuation lows, say, compared to what happened during the Ukraine war. So yes, there is serious downside if crude stays above $100 for, say, another 4 weeks or more. From here. As far as investors are concerned, as I said right at the beginning, it is very difficult to predict. As I said, on the other hand, if there is, a solution within a week, there's another 10-day pause in hostilities. So we a partial pause in hostilities, and if some settlement is reached, you're not going to get anywhere near that 21,000, and markets would fly. So it's very difficult to trade based on what you think the war outcome will be, because it's completely unpredictable. So two or three things that investors should do. One, look at a 1 year plus perspective, and unless this is a very extended war, that 1 year plus perspective still looks very attractive from an Indian perspective. India, if you're investing lump sums, or if you're I would still say that go slice it out, invest in small quantums, and not jump in. And if you see the war ending, maybe you lose a little bit that day because the market jumps. But better to focus on the certainty than try and play the uncertainty at this point. So two things. One, look at the 1 year perspective. Stop trying to look at the 1 to 2 month view. And two, invest in small batches for the time being until there's clarity that has been seen on what the long-term outcome is.
Right. Seshadri, then what's your best and of course the worst case impact when it comes to the Nifty FY27 estimates in terms of earnings?
We are currently staying with our, we have about a 15% growth for FY27, which is the, broadly what the consensus is saying at this point in time. There may be a 2 to 3% downside. You have to remember that looking at the war impact on Nifty is a little skewed, because the Nifty is, for example, the OMCs are not part of the Nifty, which are the major hit, and they are large cap companies. So it's a little optical, but the actual hit to the Nifty is very low. It's about 2 to 3%, because you got financials, tech, FMCG, I would argue, is also not really that impacted. So the percentage of the Nifty in terms of weight that has a direct or indirect impact from the war is relatively small. But that's just optical, right? If you look at the larger market, obviously the impact is much more severe. And you could see up to maybe 5 to 7% earnings impact on the broader market, and I'm just picking a number. So you could see a much deeper impact if you go down on this mid level. The problem is that at this point in time it's a little bit of conjecture, I have to warn, because the full impact will only be visible once the companies have also digested the information. I'll give you an example. There will be input cost pressures, but most companies at the moment have enough reserves in terms of inventories of raw materials. In another couple of weeks, those will start to run out. So it all depends on how long the war lasts. But we think that the impact on the Nifty would be 1.5 to 2%, or at the most 3%. But the impact on the broader market would be a little more severe.
Okay. So would you advise that it is time to only stick with the large caps instead of looking at mid or even small caps for that matter?
I'll always advise a mix of the three, because if you want alpha, you would have to look at small and mid caps, but large caps give you solidity. So it's not one or the other. It's always a mix of the three. But yes, if you see the recovery when it happens would be first led by the large caps and then the small and mid caps, because the large caps are well covered, the impact is fairly well known, and therefore investors would find more comfort in jumping in there before they try to look at the small caps. Having said that, a lot of small and mid caps have been mercilessly beaten down in this calendar year. And it's not just the post-war. You remember, even from the beginning of the year, there was a bit of a sell-off when we started the year. So my take is that the recovery would be first led by large caps. But if you're investing again from a 1 year plus perspective and building a portfolio, always have a mix, because your alpha will come from the small and mid cap, even if it is with a little higher risk.
Okay, got it, got it. Seshadri, today morning we have seen that the central government has cut some of the excise duty for all of these OMC companies. I mean, earlier we were seeing that all of these OMC companies had raised their premium fuel retail prices, and then we had them also announcing not only just hike, but we also had the central government's move. Do you think that these measures can offset the impact on profitability, given that crude is staying above that $100 per barrel?
Yes, certainly. So typically when crude jumps like this, the pain has to be shared between the consumer, the government by way of these excise duty cuts, and the oil marketing companies, which have to bear the initial pain because in the first wave, usually pump prices are not raised. So we are at the second stage. First the oil marketing companies take the pain by holding on to pump prices, even though their procurement prices are going up. When that comes to a certain point, then you see the second stage, which we are now at, where the government takes a little bit of the pain by cutting excise duties. Remember, when crude fell to very low levels in the past, the government did not raise the excise duties and did not, pass that on to pump prices. So there is a little bit of cushion there for the government to take a little bit of cuts on the excise duty, and that will probably give them and us a couple of weeks before, if this continues, before at some stage the bullet has to be bitten and the pump prices also have to be raised. So today's cut, I think, implies that pump price hikes are at least maybe 4 to 6 weeks away. The government will try and manage between the OMCs taking a little bit of pain and pump prices and excise duties. And then maybe if this continues, then at some stage the last option will be to raise retail prices.
Okay, got it, of course. Retail price hikes is something that they're trying to avoid at this point of time. Seshadri, I mean, you've mentioned in your strategy note also that IT stocks remain relatively insulated amidst all of this noise that is going on. Do you think that rupee's weakness will add to some optimism after the AI-related sell-off that we have seen?
To some extent, yes, certainly. The rupee weakness, they are fully export-oriented companies, so rupee weakness, will aid profitability to some extent. But do remember, if this lasts for a long time, we risk a sharp global slowdown, which will affect their core business because their companies are global companies, which the IT budgets of those companies are determined by the economic outlook. We've seen that through multiple cycles. So relatively immune is the key word there. I don't think anybody is 100% immune to this, but relatively, yes, they are. And IT had corrected a lot and valuations had come into very attractive zones. So from that perspective, we thought IT would be a good place to hide in if the market's correct.
Okay, got it. But anything else where you're finding value in this market apart from some of the companies that you've mentioned a slew of companies in your top trades ideas. Anything that you want to key underline and highlight here?
So I would, I think lenders have been beaten down unnecessarily. So I think the worries are 2 or 3. The first is, of course, that as the rupee comes under pressure, it will impact domestic liquidity, and that traditionally has been bad for lenders. But I would argue that there is that the damage that would be done in this cycle would be relatively low compared to previous cycles. So we are not looking at a full-blown liquidity crisis. So punishing the lenders to the extent that has happened is a bit excessive. The second is worries of say asset quality and loan demand because SMEs and if fuel prices go up, then truck operators will face a little bit of a challenge situation. I think we are not there yet. The market jumped ahead of itself and beaten down these lenders. Of course, it could be that since this is the largest sector and probably the most well-owned especially by foreign investors, they face the first wave of selling. I think that's an opportunity. A lot of these lenders have now come into very attractive zones. So if there is one sector which is directly the impact of the energy crisis is fairly limited, but yet these companies have been beaten down. They've fallen almost as much as some of the other sectors which are directly impacted. So, so that is where I see a pocket of opportunity.
Okay, all right, got it. All right, Seshadri, wonderful conversation like always, but with that we have to let you go. Thank you so much for your time and joining us.
Thank you.